right, well, let's get started. Thank you for zooming in today with us. On behalf of the Sandbox Centre, welcome to our Experts in Residence session, Financial Growth, Understanding Your Business Financials Through Different Perspectives. For those who haven't been acquainted with me or the Sandbox, my name is Mackenzie. I'm one of the 6 team members. We're located downtown Barrie and online to connect people and their ideas to business resources so that they can create a better life through business. If you haven't yet attended one of our EIR sessions before, we're happy to have you with us today. And for those returning, welcome back. Across a wide variety of topics and expertise, our EIR program provides a free all-access opportunity for you to share and receive expert feedback in order to support your business moving forward with greater clarity. Now, if you didn't know it already, your business financial statements can be considered some of the most important documents you own. Banks, accountants, CFOs, and CEOs all read the same financials, but they definitely do it differently. So when it comes to your income statement, cash flow, and balance sheets, it's important to understand how each works through various perspectives and how you can leverage it as an asset. This can definitely be a tricky road to navigate, especially if you're just starting out your business venture or jumping into a seat you haven't had experience in before. So we're super excited to have an incredible panel joining us today to provide us with their financial perspectives on how to better understand your financial statements and find out what you need to be looking for to create better outcomes for your business. I'd love to thank all of our community partners for supporting with the sharing of our events, and more importantly, would like to give a big thank you to our supporting partners, Busch Systems, BDO Canada, National Bank, and CFO Centre for delivering today's session. We're so lucky to be supported by industry experts like yourselves and have this valuable knowledge that we can connect our business community to. Before we get started, I know some of you pre-submitted questions in the registration process, which is amazing. We'll be answering those questions along with any others that may pop in your head throughout the session. So please don't be shy, use the Q&A feature that's just at the bottom of your screen, and we'll be monitoring this throughout to try and get to answering as many of your questions as possible towards the end of the session. So without further ado, let's get started. I'd like to introduce Craig Busch to kick things off. For those who don't know Craig, he's a serial entrepreneur dedicated to making the world a better place through innovative and sustainable solutions. He's passionate about supporting entrepreneurs, investing in startups, and while sharing his expertise to help them grow. As the founder of the Sandbox Centre, Craig established a transformational partnership between private and public sector leaders to open a community-led entrepreneurship center. Craig is here to share the CEO's perspective of reading a financial statement and what you need to be looking for to create better outcomes for your business. So welcome, Craig. Thanks for being here today, and I'll hand it over to you to kick us off.
Thank you, Mackenzie. Nice to be here. And thanks everyone for joining today. I have noticed that over the years that Tim Taylor at BDO and my banks don't necessarily read my financials the same way. And Jeff Bond, who's now our part-time CFO of Busch Systems, I know that he also focuses on different things. So I thought it was important to have a discussion because sometimes I'm even confused about the way others look at things. And overall, I think there's key learning to be had. We look at things as CEOs in our own way, but if we learn how others look at it, we could probably learn more about our business and how it works, because they're not looking at their things for nothing, right? Their information is giving them the information they need, so it could probably give us valuable information too. So, I kind of wanted to go through how a few things, how I read my financials. I've had about 12 companies overall over time. So I've read a variety of companies working in different markets and kind of get different feels for them. Overall, there's kind of commonality across all of them. So I'll go ahead and start with the first slide there, Megan, if you would, please. So I just pulled this one off the internet. For some reason, it didn't feel right, just like airing out my financials publicly. So I grabbed this one off the internet, and I kind of wanted to go through this. And financial statements doesn't really matter, the company or the numbers. I just wanted something readable. But it takes me about 20 seconds to read my financials if everything's working right. The top line where the first check mark is, the sales revenue, I don't have to wait for my financials to know what that number is. Yes, that will be the exact number, but I know when the month ends. I know pretty much what that number is, pretty close to that number. So that's already predicted for me. And also going back down to the third check mark, I know what my expenses are. Okay. And so I'm going to be checking to see if those deviate. But for me, I check the revenue number and then I go right to my cost of goods. And I want to know not necessarily the number, but I want to know the percentage. What's my gross profit margin percentage? I think that's absolutely key. And so I do recommend having financials that have your percentages on it, because numbers are harder to read. If you've got the percentages, you can pull out key information or variances really quickly. But that gross profit number, that's the one that can make or break you. You know, that one, if that's 60%, that goes boom right down to the bottom line, and that cuts the financials in half, right? And so I think a lot of us pay attention to our top line revenue number, but really I spend all my focus looking at the gross percentage number and going, how do I maintain that? How do I grow that? What's hurting that? When we get these financials, like when I read it in 20 seconds and everything's okay, that's great. Okay. If there's something wrong, if that gross profit percentage is not there, it's low, or profitability, or there's expenses that are high or whatever, I'm looking for variances. If it's too low and there's something wrong, I go at that, right? Deep dive it. I think what some of us don't do, and I can say that because I've got an inclination not to do it if I'm busy. If that number is too good or the expenses are too low, that really requires a deep dive too, because there's usually something wrong, and there's usually something wrong that's totally going to come back and bite you in the ass later on, that either you're not pulling inventory properly or there's some sort of anomaly. So if I was used to a financial where that number was 50% and it shows up at 70%, most of us just want to go drink beer and celebrate. We need to deep dive on that 50% and really take a look at that, because look at that 70%. If it's normally 50, you need to look at that 70% because something is wrong. You need to figure out what that is. So no celebrating. Spend your time on your financials if it's too good. Megan? So in looking at this, I kind of want to talk about keeping your gross profit number clean. You can't read your gross profit if there's clutter numbers in there. So this is the same financial we're just looking at, but I just kind of want to flag that orange arrow on the left-hand side is that other revenue. It's a line in there, and I could see maybe where there might be instances where that should be in the overall revenue, but particularly if you're selling product, you don't want a clutter number in there. You don't want not coming up off the top of my head, like interest. I don't want to see interest in there. I want to see interest down below, because it mucks it up for me getting that clean number on what my gross profit percentage is. Megan? I pulled this one off the internet, and it was a company marketing their services on consulting for accounting. And I really thought at first this was an example of what not to do. But no, I think they were saying this is what to do. And so for me, when I look at this, I'm like, I have no idea what my GP is, right? My interest revenue, like I was just talking about, is up high. My gains on sales of assets are up high. All my operating expenses in there. This could be something consolidated and as an ancillary type statement. But what you really want to look at, all this stuff that's operational, that has nothing to do. Basically, you want to know what you sold your stuff for and what that stuff that you sold cost you and what you made on that. Everything else you did around that really should be separate from that for you to really know what your margin is. Beep. Megan, yeah, okay. So other revenue that could be at the top of the financial, freight, okay, that can be part of your revenue number at the top. If you had your freight in and out, if those are in your cost of goods. If you've got them down below in your operating costs, then you shouldn't be capturing that revenue up top because it's just going to skew. They're having them in two different places doesn't work. So if you put something in your revenue, anything associated with that should be in your cost of goods. So Other expenses that could be in your cost of goods would be freight in, freight out, customs and duty, and then inventory adjustments, which can be plus or minus. Beep. A couple wild cards I've noticed on the gross profit is that one of my companies was purchasing through Busch systems, and they've gone through a huge growth curve, and we have very little margin on what we transfer, if any, between the two companies. And a couple of weeks ago, looking at it and go, hey, that was a good sales day, till I looked at the numbers and went, oh, most of that was intracompany transfer. So that was a little sad. So intercompany transfers, particularly if you're not doing it at a low margin or no margin, those will totally skew your financials. So again, in an effort to clean it up, that'll be gone from our financials in another month. If there was some, we're working with accounting, all kinds of technical things to be done to allow for that. But we wanted to get that out and clean it up. And the other one I always struggled with, it's always been an issue here, is currency, right? Fluctuations in currency can totally change what your margin is, right? If the Canadian dollar plunges and you're selling to the US and that revenue number is in real time, you can be having massive pickups and your margin goes way up, but it's not accurate. So we've had to do all kinds of things to kind of tiptoe around that before we were artificially setting our currency low. Our problem at Busch probably isn't that big a deal because we actually do hedge 18 months ahead of time on most of our foreign currency. So I'm not impacted in real time too much. So we've got more predictability there, but that one can really, really change your gross profit percentage. Megan? Thank you. So putting this in gross profit percentage in our current context with COVID, I think that the inflation rate was 3.5% in Canada. They just announced that. But for those of us in running businesses, particularly manufacturing, we know that it's not 3.5% right now. Our cost of goods are skyrocketing, right? So that number that was 70%, if we're manufacturing in particular, but if we're buying and selling things that have gone through massive inflation, we're all going to see a hit on that gross profit percentage. Like that's you take an order and by the time, or you quote something and by the time you get the order and time you're going to fulfill it, the cost of goods you were anticipating for it has gone up. Okay. And now your gross margin is down. Now, it doesn't matter. It's important to react quickly, but I don't think anybody can react quickly enough to completely mitigate that. So I would think that anybody, particularly in manufacturing, is going to take a hit on that gross profit margin over these few months where things have gone sky high. All you can do is chase it as best you can in order to mitigate that and then get back to a level playing ground later on. And who knows, maybe your gross profit goes up over time because you're able to pass along some increases. Then your COGS go down and some of that sticks to you. So, but if you don't move quickly, then it's really going to pummel that gross profit number. So there's nothing you can do to completely mitigate it, but you can mitigate it by moving quickly. And we're looking at Busch. We're doing combinations of price increases, but also surcharges. I think we've all gotten used to that on freight, gasoline surcharges over time over the years. So people know that's a temporary number, and they tend to be accepting on it, more accepting, but due to circumstances. Okay. This is a share. Good news. This is a blank one. It's not that my revenue and my cash are zero at Busch Systems, but this is something that we do every 2 weeks, and sorry, I think it's weekly now, and so. We just kind of, it's a snapshot of cash, really. We call it a cash snapshot, but it kind of tells us what our cash is, if we're into our revolving credit lines, how much that is, and then kind of where we're at on our overall cash. And then we got our AR and HST receivable, that sort of thing. And then we've got our, we take all that stuff and we come up with a differential. And that's the number that I'm really tracking. I'm looking at that. Is that number trending up or is that number trending down? Because that tells me kind of my overall financial situation. I'm also looking if, I'm taking into account inventory. If inventory's puffed up by a couple $100K, well, my differential may go down by a couple $100K because I've used my differential for that inventory. We keep an investment account. We always keep a cash reserve. And so if we've done a transfer into that or out of that, that'll also, but I do those as just kind of mental transactions. But this is a really handy thing. And I want to talk on this a little bit right now because probably 5 years ago or so, we started in 2015, we started our Vision 2020 plan and to really grow our business. And so we were doing really well. We were selling a lot. We were making really good money and it wasn't showing up on this snapshot here. So, that was very concerning. So this second check told me what was going on. And I know you could read that in cash flow. I find cash flows hard to read. And this was really the targeted information that I want. And so this tells me what my real kind of real-time financial situation is. Megan? And so what I found when I looked deep and go, where did all that yum go? I'm looking and I'm finding these cash eaters, these things that don't show up on your income statement because they're not expenses. They're things, so you're profitable, but your money's flowing in different directions. And the bulk of ours, since we were going through fast growth, was fixed asset purchases. And that could be, we were doing a lot of computer systems, paying for programs, and then also building a lot of products, a lot of intellectual property, patents, trademarks, that kind of stuff. They show as assets, so they're not expensed. Over time they are depreciated, I think. But those were hitting us hard. Loan repayments, if you got loan repayments, that money's going out. It's sucking up your cash, but it's not showing in your financial as an expense. Dividends and withdrawals, and then also loans out, to sister companies or whatever. Those are all sucking cash that aren't going to show up on your income statement. They're in your balance sheet, but it's harder work to find it on the balance sheet and the cash flow statement. So we like having that separate sheet that just tells us where we're at on any given moment. And was that my last slide, Megan? I think so. So that's it for me.
Awesome. Thanks so much, Craig, for sharing your perspective. So I'm sure many who are listening will benefit from it. We're not saying goodbye to Craig just yet. He's going to be joining us in the Q&A towards the end of the session. So just transitioning here, tying into Craig's perspective on financial statements, I'd like to now introduce Pat Jackson, partner at BDO Canada, located in the Barrie office. Pat has over 15 years of professional experience providing accounting and assurance services to clients in a wide range of industries, including real estate and construction, legal, medical, manufacturing, and retail. He successfully assists a number of clients in meeting their financial and tax reporting requirements, tax planning, business strategic planning, succession planning, and practical business advice. Pat is here to share some insights and break down the 3 important pieces of financial statements. Pat, thank you so much for joining us today.
Thanks, Mackenzie. And can you see my slides?
Nope. If you pull them up now, that would be awesome.
Okay, sure. Oops, I can't.
Perfect.
Good now? Excellent. So thank you, Mackenzie. Thanks for the introduction. And to follow up Craig's presentation, a few things key things I picked up. On Craig's fake financial statements, there is no tax. I love the tax planning there. That was great. A couple of great points Craig made. I like looking at percentages and variances because numbers in of themselves don't really mean a whole lot. And from talking to a lot of business owners, there's often too much focus on the top line revenue and not enough focus on profitability. Growing your revenue is great, but if it's not adding to the bottom line, you're just doing more work and not benefiting from it. So I love those messages. So I'm going to touch on a few things from an accountant's perspective. My focus will be more kind of on the year-end financial statements as opposed to the ongoing, but there's a lot of parallels in between. So kind of the key three key things for me from a financial statement perspective is firstly understanding, why am I producing statements? What's the point of them? The second thing is, okay, I have these statements, how reliable are they? And the third thing, I'll just touch on some of the key components and build off of what Craig said. Okay, so why am I producing financial statements? So there's users of these financial statements. So there's users now and there's users in the future. So understanding what your financial statements are going to be used for is key to make sure you're producing the correct financial statements. So some common users, as Craig was talking about, internal management, business decision making. That's probably the most important. Next, there's the creditors, bank. So Christian from National Bank's going to do a presentation soon. The government, the CRA going after those tax dollars. Maybe your customers and suppliers get copies of your financial statements. And then there's also the potential user in the future of somebody who might buy your business. So they might want to look at your financial statements and go back over the past few years. So as I mentioned before, making sure you're producing the correct financial statements for your situation is important. So what types of financial statements are there? So I guess the most simplest one, and what Craig was showing, are your internal financial statements. So those don't have any assurance on them because they haven't been vetted by an accountant, but they're very useful for ongoing operations and managing your business. The next step up is a notice to reader financial statement. So that's kind of the lowest level financial statement that a public accountant can produce. It technically has no assurance, but I know the banks get a little bit of comfort because it's been vetted by a public accountant. And depending on your borrowing level, they might accept that as a financial statement. Those standards are changing. So that might be a presentation for later in the year. But as for now, they're called notice to readers. The next step up is a review engagement financial statement. So this is what's called a limited assurance engagement. So a public accountant would do this, and they perform procedures to determine and create financial statements that are in accordance with the accounting standard. They're not quite an audit, but they provide a good level of assurance. And the resulting financial statements are very similar to what you would get under an audit. And then the last type of financial statement is a full-blown audit. So depending on what your users require, sometimes that's required for owner-managed businesses. I'd say in Barrie, for the most part, we're generally doing notice to readers and review engagements for owner-managed businesses, but there is the occasional audit engagement. The last point on here is not all opinions are clean opinions. So just because you get an audit doesn't mean you get a clean audit opinion. So it's key to understand what's in the opinions to make sure what type of reporting you're getting, because that's key to the users as well. So I did put a couple of sample financial statements. So if you're looking at your year ends, you kind of know what you're looking for. So this is the notice to reader financial statement. Again, no assurance provided here. You can see it's a pretty short report for now. Next, we have our review engagement, a little bit longer. And if you read through the wording, it's a limited assurance engagement. Lastly, we have our audit report, much longer, doesn't even fit on one page. And so that's the highest level of assurance for your financial statements. Okay, getting into the components of the financial statements. So building off of what Craig said earlier, the first financial statement is your balance sheet. So I created a little fake financial statement here. So the balance sheet is a snapshot of the company as at your year-end date. It lists your assets in the top section here, your liabilities in the middle, and then your shareholders' equity at the bottom. So it's called a balance sheet because it's supposed to balance, and it's supposed to be your assets equal your liabilities plus your shareholders' equity. You can see in the asset section here, there's assets up here which are called current assets. So that means that they'll be turned into cash within the next year. And then there's a section for longer term assets like capital assets that won't be turned into cash within the next year. So that's why they're broken out separately. And key thing here, retained earnings kind of near the bottom here. So that's the cumulative earnings that you've kept in your business over the history of time. Another way to look at it is if you were to liquidate all of your assets, pay off all your liabilities at the amount sitting on the balance sheet, that's what you'd be left with in cash. So it's kind of like a liquidation value of your business. In reality, a lot of these balance sheet numbers are at historical cost. So there could be a big difference between fair market value of the assets and liabilities and what they're on the books for. And a typical example of that, you might have land and building on here that you bought years ago, and it's worth a lot more now. But as a starting point, retained earnings is one way of looking at what the value of the business is. So some common key ratios, again, as Craig mentioned, it's good to look at percentages and variances and that type of thing. So one key thing here is called the current ratio, which is your current assets divided by your current liabilities. So above 1 means you'll have enough cash to pay your liabilities over the next year. And the higher the number, the better. Another one is debt to equity ratio. So again, that's your liabilities divided by your shareholders' equity. And that just shows how your company's strength in being able to pay off its debts. A couple other things that kind of use an income statement and a balance sheet item are days sales and accounts receivable. So that's a way of measuring if there's potentially any issues with the collectability of your accounts receivable. And similarly, inventory turnover ratio, that can indicate that maybe you have too much in your inventory or you have some obsolete items in there. Okay, moving on to the next page. Okay, so your next statement is your statement of operations and retained earnings or income statement. So unlike the balance sheet, this is the totals over a period of time. So this is how your company did over the past fiscal year and shows your revenue, your cost of sales and your expenses, and then how much your retained earnings went up or down. So Craig explained a few things on here pretty well, so I won't go into this one in too much detail. But as I mentioned before, for the users of the financial statements, potential purchasers often look at this as an indicator of what's the future potential of your business. So if you were producing this in the past, they can use what's called like a multiplier of EBITDA, your earnings before interest, taxes, and depreciation, times a multiplier could be the value of your business for selling it. So that's one key use of the income statement. And I list some common key ratios, which Craig already talked about: gross margin, profit margin. And the last one, return on investment, that's a very interesting one. And there's not too many people, not too many business owners that I know that can actually tell me what their return on investment is. They can tell me what their net income is, but they don't know what their business is worth. So if you don't know what your business is worth, there's no way of knowing what you're returning on your investment. So in this example, this business is doing very well, making $1.9 million of income. But if the business is worth $100 million, that's only a 1.9% return on investment. So that's a very important number to know, so that you know if you might be able to utilize your money in a better way. Last statement is the cash flow statement. So as Craig mentioned before, it's a little confusing and hard to understand. Typically, these are only on review and audit financial statements, but sometimes they'll be on notice to readers as well. So logically, you would think your ending cash would be the cash you started with plus your net income, but that's not the case, because in the accounting world, we make things confusing with accruals and non-cash items, those cash eaters that Craig touched on. So the components of the cash flow statement, it starts with your net income, and then it adds back those non-cash income statement items. So the most common example is that those capital assets that you purchased, you depreciate them over time. You're not actually expending cash for that depreciation because you already bought the equipment. So that gets added back. Then the next section is add back for the changes in the non-cash working capital items. So back when we looked at the balance sheet, those are your accounts receivable and accounts payable and the other accrual items. So the impact on the cash of those going up and down gets factored into the cash flow statement. And then lastly, there are those investing and financing activities. So the purchase of capital assets and bank loans and repayments. So you start with your net income, all those add backs equals your change in cash for the year, and then that should tie back to your balance sheet. So the key ratio on here that's often calculated is what's called a debt service coverage ratio. So that's a way typically that the bank will look at your business to make sure that you're going to be able to repay your debt repayments in the next year. Okay, so that's my quick 10-minute overview of how an accountant looks at financial statements, and I'd be happy to answer any questions at the end.
Awesome. Thank you so much, Pat. Really appreciate it. And it's so helpful to know the basic breakdown of those financial statements. So like Pat said, if you have any questions, put them in the Q&A feature. He'll definitely be here to answer during our Q&A period at the end. And now transitioning to our next perspective, I'd like to introduce Christian Hasou, Vice President, Commercial Banking for Ontario Central and North at National Bank. Christian is responsible for leading an experienced commercial banking team that focuses on clients and prospects located in Central and Northern Ontario. For 10 years, Christian has led his team while gaining extensive experience in commercial banking, sales, and underwriting for clients across a diverse range of industry sectors. Christian is here today to talk about how you can leverage these documents as an asset for your business and why it's important to do so. So Christian, thanks for joining us today. Really appreciate it.
Well, good morning, Mackenzie, and it's a pleasure to be here with everyone, as well as my esteemed colleagues, Pat and Craig. I haven't seen you guys in a while. Hope you're all well. I guess we have 10 minutes, so I'll just go over really high level and try to tie in everything that both Craig and Pat have introduced us so far, the different concepts and the statements. So I'll share my screen to make life a little easier here. So I think that's the one. There we go. Share. Okay. All right. Okay. So to make everyone's life easier, at the end of the day, all the concepts were all relevant to what you typically need to do when you're dealing with a bank. Okay. Conceptually, banks are like any other investor. We want to get our money back, and we want to know that your company has the cash flow available to do so. So typically what we will do is we look at sort of three elements of the financial statements to focus on, and that's everything from both working capital, which Pat obviously you alluded to. Our leverage is another area, and leverage can be a finicky one because depending on the situation, where it's just a refinancing of an existing business or versus you're buying another business, those can have different implications from a leverage perspective and could literally make it impossible to finance through a bank if we were to use traditional methods of leverage, for example. So what I'll introduce you today, really very high level, is, first and foremost, number one is, can the business itself cash flow enough to service its obligations? And so we always make our determinations based on historical results, which is the most common way. Obviously, we can't predict the future without knowing what the past is like. But secondly, the advent of COVID has had a huge impact on the ability for banks to assess those statements and get a comfort level that 2021 or 2020 results are indicative of what 2021 or 2022 down the road will look like. So clearly, we have to have some open-minded thinking as to what was it like pre-COVID, what's it likely to be post-COVID. In and itself, a very hyperinflationary environment that we're enduring right now, and I totally sympathize with Craig's comments about, our inflation rates are far higher than they're letting out there to be. And it's simple to see as a producer of any product or an exporter today. So needless to say, we do sensitize the financial statements that we do obtain. We do, as a banker, will essentially apply different sensitivities. We'll take the historical numbers, we'll do averages, we'll do medians, we'll do all this stuff that kind of gives an idea of what realistically is a predictable level of cash flow from a business. And there itself, we like to apply to two forms of debt service analysis. And the more traditional method that Pat, you mentioned, the debt service coverage ratio, and you can see that here as part of this ratio outline here just in front of you, is the more traditional method. Many often banks will use that for more simplistic sort of files. But when it comes to businesses where you're looking at more, what is the impact of their needs from a capital expenditure year over year? Are they financing that capital expenditure, or are they literally using their cash flow to finance that, not taking on bank loans or capital leases, things of that nature? The banks are far more interested in looking at what they call a fixed charge coverage ratio. And so we'll take the earnings before interest, tax, depreciation method as well, but we'll take out things like dividends and withdrawals We'll take out distributions to, let's say, related parties. We'll take out any purchases of equipment that weren't financed by either the bank or a third party, capital lease company of that nature, or any, and then we'll add back things of any kind of equity injections that were provided by the stakeholders in the company. And then we'll take those and then we'll divide them over the interest and principal payments or other required payments in a given year. And that's probably the more pragmatic approach to looking at debt service from a bank's perspective, okay? When it comes to real estate financing, those are a little more simplistic, and that's why you see debt service ratio for real estate. There in real estate, it's more cut and dry. If you're doing just a one-off real estate financing, we typically look at the net operating income and divide that over the principal payments and interest for the given year. So oftentimes real estate lending is a little more straightforward than not. But when it comes to something where you're buying a building for your business, operating business, we call that an owner-occupied scenario. We'll oftentimes use the fixed charge coverage ratio analysis in order to make the best guess or idea understanding of the capability of the company to service its obligations. Having said all that, having great debt service coverage is a critical point of view, of course, probably the number one thing that we need to know. But secondly, we'll look at things like, well, does the company have adequate working capital? So we have companies oftentimes that will come to us and they have robust sales, but they tend to essentially wipe out their equity every year, and they're almost virtually have no equity in the company. They literally figure they don't want to keep the money in there, and they take it out. But then it makes it difficult for the bank to say, yeah, well, that's great, but you need to have skin in the game. Oh, and by the way, you need to have some cushion for your working capital, because if we have a negative working capital situation for a bank, essentially that defines the company as being insolvent in the next 12 months. And we don't want to be working with those problems. So oftentimes we'll try to find solutions where we can apply, let's say, a solution where we put a term loan in, pay out the line of credit, so that way what we do is we free up some working capital and give the company more time to repay that obligation over a number of years versus the next 12 months. So there's some solutions we apply. The other thing, of course, from a leverage perspective that I wanted to bring up is traditionally we'll look at debt to tangible net worth, which is another ratio, very traditional. We look at the overall debt of the balance sheet and we divide that by essentially what would be equity plus any subordinated debt, less any goodwill or other intangible assets. And that ratio is a very traditional method for which banks gather the leverage for a company. And traditionally 3-to-1 is sort of the threshold that most banks will look at to assess if anything in excess of 3-to-1, they might be apprehensive to move forward on, okay? Now, having said all that, at our level on the commercial side, we typically work with financial statements that are, review engagement mostly, but we do have occasions for files where the statements might be notice to reader, as Pat alluded to. And with the essentially the evolution of the statements over the next year or two to come, there might be more enhancement in those notice to reader statements that will essentially allow a bank to have as much information they would from a review engagement and potentially save the customer ultimately the additional costs of the assurance of work that's done if the enhancement in the review in the notice to reader statements is adequate for our needs. So just to be wary of that as well. But when we talk about leverage, one of the things that happens oftentimes is a company looking to buy another company. One of the metrics that's resulting in one of the things, the byproducts of an acquisition at times can be what we call goodwill. So essentially what you're paying for at a market value today versus what the book value of those assets are historically, there might be a discrepancy, which is positive to the seller, but for the buyer, that could be detrimental, particularly when you're looking at something like a tangible net worth ratio. So oftentimes what banks will do in those scenarios is they'll probably apply a different ratio, and it would be something what we call a total interest-bearing debt to EBITDA ratio. That's another form of leverage analysis that we do, and we typically apply that for more complex files where there's a business transfer scenario involved. Obviously, I'm giving you guys a lot of the technical aspects of it right now, but I think it's probably best answered in the question and the Q&A section for anyone that wants to learn a little bit more about what that means and how it works. But essentially, the bank's view is that if we can keep the overall leverage, or I should say overall interest-bearing debt to the EBITDA historically generated by that business under 3.5 to 1, from a senior perspective, we're typically very comfortable with that leverage for a business acquisition scenario. Okay, so I think I've pretty much eaten up my time. So let's I'll pass it on to Mackenzie, and we can go through some Q&A after this.
Awesome. Thanks so much, Christian. Appreciate your insights here today. And now, last but not least, we have one more financial perspective to get through. I'd love to introduce Nigel Fenty, Principal at CFO Centre, York Simcoe. Nigel has a track record of rapidly building better businesses in a variety of industries, including SaaS technology, construction materials, manufacturing and distribution, and automotive retail. His most recent experience includes successfully leading finance, capital raising, and business or turnaround efforts for a worldwide technology group of companies. Nigel is here today to share some clear insight into growth profit margins. And welcome, Nigel. Thanks so much for joining us today.
Thanks, Mackenzie, and thanks to everyone else for participating. It's fun to be here. Thanks, Craig, for giving me a really good overview about gross margins. I don't even have to go through my definition slides anymore. So I'm hoping you guys can see the presentation on screen. So I'm gonna jump right in from where I'm at right now. So why are gross margins important? So, you know, I've had lots of interesting conversations with entrepreneurs, especially, you know, since I've been working in the tech space for the last few years. And, you know, and what I've found with these tech entrepreneurs is that they tend to look at things slightly differently. You know, they've almost forgotten about gross margins and the importance of gross margins, right? And they talk about, you know, monthly recurring revenue being higher than your monthly expenses. They talk about, you know, as long as your customer, you know, lifetime customer value, you know, is covering your customer acquisition cost by 2x or 3x, you'll make money. So why do I care about gross margins? So, but what I said to them and what I'm saying to you guys is, look, gross margins lead to much better conversations about how to improve your business, how to improve the performance of your business. Because as you get down to it, you got to talk about the things that are really at the core of a business, right? What's your unique value proposition in the market? You know, how can you price? What does your competition look like? And that's the things that will help to determine how you can price in the market and your ability to maintain those prices. And you got to talk about, you know, your main suppliers. You know, for tech companies, it's all about, you know, maybe server space from AWS, and manufacturing companies, it's purchases and inventory and your labor force. But it really drives you to have those more important conversations about what are the things that can actually improve the profitability of your business, and by extension, improve your business. The stronger your gross margin, as Craig so aptly put, you know, you say, yeah, he had magic number. It really is an extremely important number in determining the profitability of your business and what you'll be able to do to improve your business. I mean, let's take a look at it from an even slightly different perspective. You know, one of my favorite shows that I like to watch on TV is the Shark Tank, which is more from you know, that's early stage entrepreneurs trying to, you know, raise money from some more seasoned, experienced business people and venture capitalists. And typically when you go through those presentations, you know, one of the first questions that the entrepreneur asks, I mean, outside of, you know, what are your sales? Because yes, they need to have some sense of, you know, are customers willing to pay for it? But almost the second question that happens on every single occasion is, what do you sell it for? And what does it cost you? That's a gross margin question. And the reason that they ask this question so early on is because it really provides some critical information about the viability of your business model, because that one question speaks to profitability. It speaks to the ability of the business to generate cash flow. It speaks to the ability of the business to need further funding, which is how the investors tend to look at it. They want to see something that's profitable. They want to see something that is generating enough cash flow. And they're concerned about how much money they may need to put in the future to keep the business going. So, gross margins, so let's dig into that a little more. I mean, gross margins and its very close cousin, which I call contribution margins, which is just taking all of the other remaining variable costs that are not in the gross margin section, and you're subtracting that from your sales. These are things, like, I've worked with a lot of companies, and I've found that it's very, very useful to use those numbers to do some financial modeling, so that you can figure out, what are the break-even levels of business that you're at if you're in the earlier stage. And if you're beyond that stage, great, congratulations. Now it's about, how strong or how big a profit margin can you get? How can you de-risk this business? As a result of, the stronger the profits, the less risk there is in the business, from internally, from Christian's perspective, from, as a banker, from the investor's perspective. But to get to this higher profitability, you really have to think, take a step back and think about, again, those key pricing decisions and those key margin decisions that you're doing, and your main resources. What do you need to do? What can you do to increase that gross margin? It's also very important because it also helps to drive what is, your internal cash flow generation. I mean, the one key metric that we always try to talk about is, what level of profitability do we need to get to so that you can get to the point of self-sustaining cash flow? And that's a very important, level in a business to get to, because that's where you can fund all of your operating costs without any external funding, and you're not pulling up, you're not needing cash just to pay your normal month-to-month bills. Using gross margins and contribution margins are absolutely critical in trying to assess, where do you need to get to that point of self-sustaining cash flow, which from the investor perspective is equally important, because they want to ideally think that, this business can fund its day-to-day operations, and maybe it will need funding to fund growth, or to buy some capital assets or some equipment, or bigger machinery. Those are all things that investors are happy to fund, not so much when they are having to fund payroll. I've also found, I've been involved in 3 major business turnarounds, and what I've found is that gross margins are absolutely essential to build good, strong business turnaround plans for business. I mean, you have to look at everything in turnaround situations. You got to look at your fixed costs. You got to look at every single supplier. But what you tend to find is that focusing on that gross margin is usually more effective in terms of implementing a faster turnaround. In fact, in most fast turnarounds, as I have on the slide here, I mean, one of the things that turnaround practitioners will tell you is that focus on those best margins. Find the best margins that you can earn in your business, and drop absolutely everything else, and just focus on that. And then from there, you can use that essential strategy to try and build out over the next few years how to improve your gross margin, because by improving your gross margin, you are essentially improving your business, right? And to improve those gross margins, you pretty much have to touch on all the important things that you'll need to consider. Your labor. Do you need to outsource? Do you need to insource it? Even for production, should you really be doing it internally, or should you be outsourcing it? And without a proper understanding of those numbers, it is difficult to put together a really solid, strong turnaround plan. I have a very simple example, right? Let's pretend that this is a retailer. It's a he has a max convenience store. You know, he earns $2,000 a day. His cost of sales are $1,600 a day. He has a gross margin of $400 a day, and his fixed costs per month are at 10 grand, including, you know, his salary, the rent of his team, everybody, and the salaries of his team and everyone else. So with this setup, he's making no money. He's actually just barely breaking even each month. So what are the better levers that you can try and pull to improve the profitability of this business? Is it trying to improve the gross margins by 10 or 20%, or reducing fixed costs by 10 or 20%? The other thing you have to consider as well is timelines. Fixed costs are much faster to wind down in many cases. You can renegotiate with Bell, and you can get a better contract for your supplies and some of those other things. Improving gross margin tends to take a little more time and is a little more involved, but it's generally more effective. So I don't think anyone in this audience will be, you know, surprised to hear that. But what's interesting about just modeling even this very simple scenario here is how much more effective it is. If you reduce those fixed costs by 10%, this retailer is breaking even. Great, he's earning $1,000 a month. If you increase it by 20%, double it. But by focusing on the gross margin instead, by just improving it by 10%, and you know, it can be a combination of you increase your selling price by 5%, reduce your cost of sales by 5%, it's 5 times more impactful in terms of the contribution to the bottom line. And if you're lucky enough to be able to improve your gross margin over by 20%, even if it takes you a year and a half to get there, you improve your sales 10%, you reduce your cost of sales, 10x. It's a 10x impact. It's that much more impactful. So while you have to do everything, I think you guys will both agree that focusing on that gross margin will get you to your goal a lot faster. And you know, my last comments, because I can see I'm running out of time here, is that, you know, you have a good, strong gross margin improvement plan. It will really lead you to have improved credit worthiness for the investors, as Christian was talking about as well. Gives you a more focused plan of attack in terms of how to improve your business. And with those, you can get the both improve revenue and improve profits that you're looking for, and that helps to get you a better exit value. So I'll stop there, and thanks everyone, and I'll hand it back over to Mackenzie.
Awesome. Thank you so much, Nigel. Really appreciate all the examples. And I'd love to invite now all the panelists to join us back for a little Q&A. I know we're running a little short on time, but that's okay. If people want to stick around, that is awesome. And we'll get started into a couple. First, we have, what advice would you give when it comes to keeping great records and how to share data with joint venture partners? Perhaps, who would like to take a stab at answering that first?
I can jump in. So from an accounting perspective, I don't know what accounting system the person asking the question is using, but there's a lot of great cloud solutions now where the information is readily available online, and the joint venture partners could just log in and see the information live as it's ongoing. So without knowing any other information, that would be my recommendation, would be to potentially look at one of those solutions.
Perfect. Would anybody like to add? Go for it, Craig.
I would suggest dashboarding to be able to have accessibility, figure out together what your key metrics are, make them clearly visible, graphic representation. So it's just a people quick check-in, and that really flags if something's off quickly for everybody.
Awesome. We'll move on to the next question here. Through a financial lens, what are the top 3 things you should or would put emphasis on when starting a business? So I guess from that entrepreneurial lens. Craig?
Yeah, I don't know about you guys, but I'm thinking gross margin.
That was a common theme.
For me, gross margin, cash. Those would be the 2 that I would. So maybe somebody else has got a third.
Yeah, no, that's the point of self-sustaining cash flow that I was talking about briefly in my overview. That's a really important step in the entrepreneur's journey to, so you want to be modeling that right from the very start to see how long is it going to take you to get there, because until you get to that point, you're going to need outside capital.
Perfect, thank you. The next question we have here, financial statements, whether monthly or yearly, are retrospective in nature. What should owners do to be on top of and manage to a more planned or favorable outcome? Should all the owners buy into an operating plan for the year and then have rigorous financial procedures and policies and signing authorities so that financials do not get off the rails during the year and increase probability of then coming to the end of the monthly year without surprises? What are other things that can be put in place? Who would like to take a stab at this question?
Yeah, those are all good solutions, but I would recommend as well that you really have to strengthen your forecasting. You want to have that rolling 12-month, 18-month, 24-month, depending on what your business horizons looks like. You really have to have that rolling forecast that builds on those historical financials, so you can see where you're going and what you need to do to improve the business, right? And be able to anticipate issues down the road. So yeah, I would say those rolling forecasts are in many cases becoming even more important than annual budgets.
Yeah, just to add one thing to that. So like, as we kind of talked about a few times, it's easy to get lost in the numbers. So as Craig said, picking out a few key performance indicators is key to managing your business well. And depending on the accounting system, it can take days to produce those numbers. So there are software options out there like Power BI options where regardless of what accounting system you're using, it just automatically plucks the information so you can see those numbers live throughout the year, so you can manage it on a day-to-day basis at the click of a button.
Cool,
So
thanks
that's
for the tips. Yeah, those are perfect. Somebody's asking actually for BDO on the topic of assurance, is there a methodology to use when moving up assurance levels? For example, we started with a notice to reader and moved up to a review. What would help guide us when deciding to move up to the next level of assurance in audit?
Sure, very common question. So like everything else, it's a cost benefit decision. So what's the cost to move up an assurance level from a professional fee perspective? So check with your advisor. There's also a cost time value for your employees. As you move up assurance levels, it's more time consuming for the business. And then on the benefit side, is it something you need now? Is Christian saying, hey, you need an audit to get that loan? That's a pretty easy decision. If it's, oh, we might sell in a few years, so we might want a higher level of assurance to help with the potential sale, then that's a bit harder to gauge what the benefit might be. And then just dollar amount. So how big are the dollar amounts in the financial statements? I'd say as a general rule of thumb, it's not very common to move up from a review to an audit unless it's required, because you're getting the same level of financial statement reporting in the financial statements, and the cost is quite a bit more. So I would say generally you would only move to an audit if you really needed it. You had identified a real need, whether immediate or in a couple of years.
Perfect. Thanks, Pat. We'll try and squeeze in two more questions here, trying to just be respectful of everybody's time. So one last question, do you recommend that detailed shareholder agreements be established before investments are made by a large group of investor owners so that reported financial statements are then reflective of the approved shareholder agreement? Who would like to answer this?
Yeah, shareholder agreements are foundational and really help to prevent a lot of misunderstandings and misalignments down the road. Yeah, if your shareholders agreement speaks to financial statements and expectations on financial statements, then yeah, for sure, it will drive everything else.
Awesome. Thanks, Nigel.
And just a quick thing to add to that. Also, exit on a business is key. Like if you don't have a shareholders agreement and you have multiple shareholders, how after the fact do you determine what's a fair way for people to leave? So you got to do it at the beginning.
Perfect. Thanks for adding that, Pat. And one last question here. How important is cost containment when revenues are not clear or can be choppy? Go for it, Craig.
Yeah, it's the only thing you can control. right? Like you can control what your overhead costs are, your operating costs. Revenue, you're doing your best to drive it. And then we talked about GP is something that you can influence. You can't control it, but you can influence it. But the only thing you can control is the operating costs. So I think super important.
Awesome. Does anybody have anything else to add? No? All righty. Well, thank you to all of you for joining us today. Craig, Pat, Christian, and Nigel, your perspectives were extremely insightful, and I can't believe we got that much in an hour. So that's incredible. I know I'm walking away with so much information. I know, woohoo! Massive thank you to our supporting partners, Busch Systems, National Bank, BDO, and CFO Centre for delivering today's session. Registrants who couldn't attend this session today will definitely be provided a link to the recording afterwards. So keep an eye on your email. Our experts and resident sessions vary from month to month, like I said, across many different topics. So be sure to go check out sandboxcentre.com and our events page to get in the know. We actually have an EIR coming up next week with Larsh on winning at digital advertising in 2021 and beyond. So make sure you go check it out. In the meantime, we appreciate everybody joining us today, and we wish you a safe week ahead. Thank you again so much, gentlemen. Really appreciate your time today.